Hello class, welcome to week 2 in Financial Accounting 1. Today we're going to learn how to do adjusting entries and by the end of and closing entries. And by the end of this class, you will have gone all the way through the accounting cycle, which is a huge accomplishment. The rest of the class will be structured a little bit differently for weeks 3, 4, and 5. So in week 1 and 2, you cover everything that you have to do in the accounting cycle from beginning to end. The first thing I'm going to do is I'm going to share with you the IP. We talked a little bit about what was required in IP1. And so last week when we looked at the journal entries that you did. So this week, the first thing I'm going to do is I'm going to pull up that individual project and we're going to kind of look at it so that you can see that it's nothing that you're not capable of doing. Every single piece of this initial individual project we covered last week. So I will talk to you about how to approach it and how to be successful at it. So I'm going to go ahead and share that. I pulled up our classroom. So here's your classroom, and this is the first IP. So the first thing that you have to do is it's a company that has just been set up. It's brand new, exactly like what we did in week 1 when we talked about those 11 common transactions. So this week you have, as I promised, transactions that you have to record. What you're doing in this IP has nothing to do with what we're learning today, because today we're going to talk about adjusting and closing entries, which is what you do after you finish these transactions. So what you have to do for this IP is you have to record 10 journal entries. Now, you should notice that these are very similar to the 10 journal entries that we worked on last week. So pull up that recording and look at it as you go. Earning 100% on this IP is very simple, because let's look at the rubric, which is down here. So on the rubric, you have to journalize the 10 transactions. Once you journalize those 10 transactions, the rest of the points are easy to pick up because you have enter the correct accounts, enter the correct amounts, and then write the journal entries in the correct format. The professional language doesn't really apply because if you do the journal entries correctly, you have the professional language correct. So I do want to give you one reminder because it's really important. So let's review the thought process. So number 1, what happened? So make sure that after you read the transaction, you really understand what happened, because that's going to be the key to recording the transaction correctly. Then number 2, what accounts are affected? And remember, that's like specific accounts, like cash, accounts receivable. Number 3, did it increase or decrease? Number 4, what type of accounts? And that's like, is it an asset? Is it a liability? Is it revenue, expense? And then last but not least, debit or credit. And then you can write down the journal entry and that is it. So this is very doable. I know you probably feel a little overwhelmed right now because you've learned a lot of material in 1 week, but this IP is very doable and it will help you solidify what you learned last week and move into the material for this week. All right, I'm just going to stop sharing for a moment and pull up our PowerPoints. All right, here we go. This week, we're going to learn about adjusting entries. And in order to learn about adjusting entries, the first thing that we have to do is we have to learn about accrual basis, cash basis accounting. Accrual basis versus cash basis accounting only has to do with when we recognize revenue. Do you recognize revenue when it's earned, or do you recognize revenue when the cash is received? Do you recognize expenses when they're earned, or do you recognize expenses when the cash is received? And this is one of those concepts that sounds really simple when I bring it up, but in reality, it is a little bit more confusing because we're used to thinking of things like, oh, I earned revenue, I got my paycheck today. Well, that's not when you earn the revenue. That's when you receive the cash. You earn that money every single day as you go to work. So for a company, if we do a job for somebody, you earn the revenue when you complete that service that you performed. You might receive the cash right then, or you might receive the cash 30 days later, but you earn the revenue when you perform the service. The same thing is true for expenses. You incur the expense at the time that you use that service up. That's when you incur the expense. And the reason that accrual basis accounting works well is because it helps us match the same period between revenue and expenses, so that on your financial statements, you can see, okay, we earned the revenue this month, and here are the expenses in the same month that were incurred to earn that revenue. Cash basis accounting, we will not use in this course at all. Cash basis accounting is you recognize revenue when the cash comes in, and you recognize expenses when the cash goes out. Everything we do is going to be accrual basis accounting. Because we use accrual basis accounting, we have to do adjusting entries. So adjusting entries happen for situations like, remember last week when we talked about unearned revenue. I got a deposit from the hotel that I was manufacturing cushions for. I hadn't earned the revenue yet. I earned it by manufacturing the cushions, but they gave me a deposit in advance. When they gave me that deposit in advance, I recorded a liability. I recorded unearned revenue. So what we're doing with adjusting entries is like, now I have to go back and I'm going to recognize the revenue that I have earned. So for example, a deferred expense, deferred means I put it off. So if you think of it that way, it's like I put off the expense. I'm not recognizing the expense right now. I'm going to recognize it later. So an example of that would be the prepaid expense. Like if I prepaid insurance, that was the example we looked at last week. I paid my 6-month insurance policy in advance. I don't have an expense right now. I did spend cash, so I've recorded that I've reduced cash, and I recorded an asset because a prepaid expense is an asset. But now my adjusting entry is going to be to record the expense that I've used. So in this example, now I would record insurance expense each month as I use it, and I would reduce my asset, my prepaid expense. One thing that you should realize is you're never going to have a cash account when you're doing adjusting entries because cash always came before. In this case, we spent the cash before and we recorded a prepaid expense. The next example is deferred revenue. Again, deferred means I'm not going to recognize revenue now, I'm putting it off until later. So an example of deferred revenue is my unearned revenue. My deposit in advance for the cushions that they gave me. So the adjusting entry is going to be, I'm going to now recognize that revenue. Accrued expenses, see, thinking ahead, accrued expenses and accrued revenue don't have anything that happened in advance. Deferred expenses and deferred revenue have a transaction that happened before, but accrued expenses and accrued revenue don't have anything that happened in advance. Instead, those are simply going to be, you're going to record an expense that occurred, but you hadn't recorded it yet. And the fourth one is you're going to record a revenue that occurred, but you haven't recorded it yet. An accrued expense, a common example of that is salaries and wages. At the end of the month where you work, the company owes you, has incurred a salary or wage expense, even though they haven't paid you. They've incurred that expense because it's the last day of the month, they owe you money for work that you've done. So that's an example of a common accrued expense that's going to be recorded as an adjusting entry at the end of the period. A common example of accrued revenue might be, let's say that we are doing work on the 30th and the 1st, and we're going to collect that money or bill the customer after the 1st when we finish the job. Part of that revenue was earned in the previous month. And that revenue that was earned in the previous month needs to be recorded in the month it was earned. So we do an adjusting entry to record that revenue. So accrued expenses and accrued revenues don't have anything that happened in advance. Okay, let's look at examples. So this is a prepaid expense. We already talked about prepaid expenses are assets because something happened in advance and we have a benefit that's coming from them. We talked about prepaid insurance. Two other examples are like prepaid rent. If you pay rent in advance, like when you lease a space, often you pay the first and the last month's rent. And supplies. We consider supplies a prepaid asset because a prepaid expense because we purchased the supplies. And right now they're on our balance sheet as an asset. As we use them, we're going to record an expense. So here's the way it works. And this is where I said, now you're going to use T accounts to see the flow of dollars and cents, which is how we really use them in the real world. So if we have a prepaid expense, we first recorded an asset, and then we recorded later on an expense. So the asset got recorded when we purchased or when we spent the money on the prepaid insurance or prepaid rent or bought the supplies. When we do the adjusting entry, we're going to reduce the asset, and we reduce an asset with a credit, and we're going to record the expense. We record an expense with a debit. So this is how it looks. So let's say that we paid $2,400 for a 24-month insurance policy. So if we paid $2,400 for a 24-month policy, we know that each month we're going to have $100 worth of insurance expense. When we purchase that policy, we're going to do two things. We're going to reduce cash and we're going to increase our asset. So before anything happened, we spent the cash, so we reduced cash and we recorded our asset. When we record an asset, we debit it. So that's how we got the $2,400 in prepaid insurance. That's where we're sitting right now. This happened on December 1st. So now we want to, at the end of December, we want to record 1 month's worth of insurance expense. When we record that insurance expense, we have two accounts, prepaid insurance and insurance expense. Insurance expense increased. Insurance expense is an expense. If we increase an expense, we debit it. So we're going to record insurance expense, and we're not going to touch cash because we spent cash when we paid that $2,400. Instead, we're going to decrease the asset prepaid insurance. So now on our balance sheet, On our balance sheet, if you looked, we would have a $2,300 balance in prepaid insurance, and we would see this insurance expense on our income statement. On our income statement, we would now have $100 worth of insurance expense. And this is what the journal entry would look like. You're going to debit insurance expense because you increased it, and you're going to credit prepaid insurance because it's an asset and we decreased it. Let's look at supplies. When you're given the information about supplies, you're going to be given it one of two ways. Either you'll straight out be told, we used X amount of supplies. If you're told we used X amount of supplies, that's the expense. So when you're looking at supplies, what we used is the expense. However you get to that number. In this case, we're told that we purchased $9,720 worth of supplies in December. We know that when we buy supplies, we decrease cash and we increase supplies. So when we purchase the supplies, that's how we got this $9,720 in supplies. At the end of the period, we have $8,670 worth left. So what that tells me is I have a balance of $8,670. So the question is, how do I get from 9,720 to 8,670? And I get there because I have a credit to supplies. And this credit is the supplies used or our supplies expense. So the difference is this $1,050. And this $1,050 is my supplies expense. And I'm doing the same thing here. I'm recording an expense and I'm reducing my asset supplies. And here's what my journal entry looks like. I'm going to increase my expense with a debit. So I debit supplies expense, and I'm going to decrease my asset supplies with a credit. So I credit supplies. Depreciation. Depreciation is a new concept. When we purchase an asset, we record it on the balance sheet. So let's say I bought a $500,000 piece of equipment. I record it at its historical cost. I put it on my balance sheet at $500,000. Here's my $500,000 piece of equipment. It sits there on the balance sheet, but I know that I have to match revenue with expenses. And I know that that piece of equipment is earning revenue for me. So I have to match the expense with that revenue that it earns every month. I do that with depreciation. Depreciation has absolutely nothing to do with the market value. The only purpose of depreciation is to record the expense of the asset to match it with the period where it's earning revenue. Later on in this course, we're going to talk about other methods of expensing depreciation, of calculating the depreciation expense. This week, we're going to look at straight line. So there's a couple of components. The first one is the cost of the asset. This cost of the asset is what you see recorded on your balance sheet. The salvage value is assigned by management, and you'll be given the salvage value. The salvage value is what we think the asset will be worth at the end of its useful life. The useful life is how long that asset will continue to generate revenue for us. Now, in reality, most people use the IRS tables for the useful life of an asset. And I'm telling you this because, one, that's the best place to look up the useful life, but also, let's say that we buy a desk. A desk is an asset. A piece of furniture has a 7-year life. Now, does that mean that after 7 years we have to get rid of the desk? No, that wouldn't make any sense. Does it mean that after 7 years the desk is falling apart and we can't use it anymore? Probably not. I bet you have a lot of furniture in your house that's older than 7 years. So sometimes we have an asset, we continue to use it to generate revenue, even though we have depreciated it fully. And that's okay. That's going to happen. Everything with depreciation, except for the cost of the asset, is an estimate. And it's okay to have estimates that aren't right on, that it's not going to fall apart. So we're going to take the cost of the asset and subtract the salvage value. What that does mathematically is it kind of sets aside that salvage value so that when we're all done depreciating the asset over its whole life, we still have the salvage value left sitting there as the remaining book value on our balance sheet. Let's do an example. It's the best way to understand it. So let's say that we purchased equipment that cost $26,000. It has an estimated useful life of 5 years and a salvage value of $8,000. We bought this on December 1st. When we buy the asset, we record this journal entry. When we buy the asset, we increased equipment with a debit, and we either did cash or maybe notes payable for $26,000. So now, sitting on our balance sheet is this equipment. We want to record an expense related to that equipment. So what we're going to do is we're going to use our formula, and we're going to say our original cost was $26,000 minus our salvage is $8,000. So our net cost that we're going to depreciate is $18,000. That's called our depreciable cost. We take $18,000 divided by 60 months. That gives us a $300 cost. So what we're saying is our monthly depreciation expense is $300. Our monthly depreciation expense is $300. Okay, this is what the journal entries look like. Originally, we bought our equipment. We've recorded our depreciation expense, and the other account is brand new. The other account is accumulated depreciation. Accumulated depreciation is a new type of account for us. It's called a contra asset. What that means is that this asset is recorded on our balance sheet and it's linked to the asset it's related to, but it has the opposite balance. So instead of being having a debit balance, it has a normal credit balance. So this is what our journal entry looks like. And this is what the journal entry for depreciation will always look like. We have a debit to depreciation expense and a credit to accumulated depreciation. So on our balance sheet, the accumulated depreciation reduces the book value of the asset, and the depreciation expense is going to be on the income statement. When we're done, this is what our income statement looks like. We have equipment, $26,000, less accumulated depreciation, $25,100. Okay, I'm going to pull up a different slide deck, so hold on one moment. Okay, let's pull up let me pull back up the next part of the PowerPoint. All right, so now this is the easier part. Now we're going to talk about deferred revenue. So with deferred revenue, we have put off recognizing that revenue. So it works the same as deferred expenses, except for now we're talking about revenue that we're earning. So when we collect that deposit, we record a liability, unearned revenue. Later, as we earn the revenue, we're going to have to record the revenue that we've earned. Now, again, the cash happened when we recorded the liability, not now. So here's what's happened. This looks a little confusing. So here's what happened. We paid Fast Forward's client paid a 60-day fee in advance. So we collected $3,000 cash in advance. When we collected that, we recorded the liability unearned revenue. This is a 60-day fee. So over the next 60 days, we're going to earn revenue equal to $3,000. Right now on our balance sheet, we have the liability unearned consulting revenue. So if we look at this and we say, okay, this happened on 12/27. So, and we're going to earn it through 2/24. The first thing we're going to do is we have to record the revenue for December at the end of December. So we have the 27th, the 28th, the 29th, the 30th, and the 31st. We have 5 days of revenue that we have earned. So if we take 5/60ths of $3,000, at the end of December, we have earned $250 of revenue. We need to record that. That's going to be our adjusting entry. Our adjusting entry is recording that $250 worth of revenue at the end of December. So this is what it looks like. On our balance sheet at the beginning, when we receive the unearned revenue, when we receive the deposit, this is what we've recorded. We're going to reduce our liability with the debit, and we're going to increase our revenue with the credit. So we increased our revenue. This is on our income statement. On our income statement, you're going to see $250 in consulting revenue. And we decreased our liability. So on our balance sheet, this is going to be what you're going to see as the total for this liability. What this is here for, this $5,800, this is just our beginning balance. It has nothing to do with this transaction. That would be our beginning balance, what we've already earned in consulting revenue. And then this is our $250 that we added. So our total $6,050. But that beginning balance has nothing to do with this transaction. This is what our journal entry is going to look like. We're going to debit the liability, unearned consulting revenue, and credit the revenue to increase it. Accrued expenses are easier because all we're doing with an accrued expense is recording an expense. You literally did this in week 1. All we're doing is recording the expense. And because we're not paying it right now, because remember, if you're doing cash with an adjusting entry, you're doing something wrong. Cash is never part of an adjusting entry. It either comes before or later, but it's never part of an adjusting entry. So we have our accrued expense. We're going to record the expense that occurred that has not been recorded, and we're not paying it right now, so we're going to record the liability. Salaries is a common example, and it's tricky because it's one of those adjusting entries that the amount changes every single period, every single month. So here we pay our employees $70 per day, or $350 for a 5-day work week. We pay salaries every 2 weeks on Fridays. So you kind of have to picture that in your head. Payday is on Fridays. That's when we pay the employees. The reason this is important is because in the real world, we typically record the salary expense when we pay the employees. 12/31 is a Wednesday, and there's 3 days of salaries that are owed. So what this tells me is on 12/31, we haven't recorded the salary expense for 3 days. We would typically record it when we pay the employees in January. However, we need to recognize all of December's expenses in December. So we want to record the 3 days of salary expense. So at $70 a day times 3 days, we have $210 worth of a salary expense that we have not recorded. That's the hard part. The easy part is recording it because we recorded expenses last week. If we have an expense, and it went up, we increase an expense with a debit. So we're going to debit salary expense, and we're going to record the liability salaries payable. What we'll see here is that on our income statement, we'll see salaries expense, and on our balance sheet, we'll have this new liability salaries payable. So this is the way the flow looks in our T account. So we've increased salaries payable. We've decreased salaries payable with the credit. No, increased salaries payable with a credit. And we've decreased, let me start over. We increased salaries payable with a credit, and we increased our salary expense. Now, this is just our beginning balance from previous salaries. It has nothing to do with this entry. In the future, and this is where it gets tricky, in the future, when we pay the salaries, we have to realize that we already recognized of the 10 days, because every pay period is 10 days, right? We recognized 3 days worth in the previous month. So we already recorded the expense for these 3 days last month. So here we're going to reduce our liability by the $210. We're going to record salary expense for the 7 days that were in January. And we're going to reduce our cash for the entire payroll. So that $210, if you go back here, that $210 was this balance right here. So we started with a $210 liability, and then after we pay our payroll, that liability is gone. Now it's zero. Accrued revenue works the same way. Accrued revenue is revenue that we've earned, but we have not recorded it yet. So we're going to record the revenue, and we're going to record a receivable. We're not going to record cash because we haven't gotten the cash yet. If we had, we wouldn't be doing an adjusting entry. We'd just do a regular entry. So here on December 12th, a customer paid us $2,700. A customer agreed to pay $2,700 on January 10th of the next year for future services for the next 30 days. So what happened was at the beginning of December, they said, we'll pay you $2,700 in January, but you're going to start doing the services now during December. So at the end of December, we had performed 20 days worth of the 30 days of services. So of that $2,700, we had earned 20/30ths of it. We had earned $1,800. But we haven't recorded it yet. Typically, we would record it when we get the cash. So we haven't recorded it yet. But we need to, because that $1,800 was earned in December and needs to be recorded in December. So we're going to increase our revenue. We increase revenue with a credit. We're going to increase our revenue, and we're going to increase our account receivable. We increase an asset, which is accounts receivable, with a debit. So we're going to debit accounts receivable, and we're going to credit consulting revenue. Now, on your balance sheet, you'll see accounts receivable, $1,800. And on our income statement, we will have increased our consulting revenue, $1,800. So just like the other examples, this is just our beginning balance. It has nothing to do with this journal entry. Here's our $1,800 in our accounts receivable, and there's our $1,800 that we increase consulting revenue. In the future, they're going to pay us. So on the 10th of January, they're going to pay us the $2,700 in cash. So we're going to do two things. We're going to recognize the cash. So we increased our asset, cash, with a debit, $2,700. We're going to decrease our receivable, and we're going to record the last 10 days worth of the revenue. So we're going to record the last 10 days worth of the revenue. And that's how we get the consulting revenue of $900 for January. This $1,800, we already recorded that revenue. We recorded that revenue in December when we did our adjusting entry. This is what it looks like with your financial statements. Just a summary of the debits and credits. That brings us to our trial balance. So this is an adjusted trial balance. So the way this works is this is actually a worksheet. And I wanted to point out a couple of things. So in these columns are the adjustments that we've made. So what we have here is like accounts receivable started out with a $0 debit. We increased it $1,800 with a debit. That means we have an $1,800 debit balance. You have to be very careful adding these, because let's look at supplies. Supplies started with a $97.20 debit balance. That's what we purchased for supplies. We credited it for what we used, the $1,050. Our balance is a debit, because if we take a debit in supplies, what we really have here is, here's our supplies T account. So what we really have is we started with $9,720. We used $1,050. Our balance is $86.70. So you have to be very careful when you're adding across. The other thing you want to notice is this is our original trial balance. The debits and credits equal. These are our adjustments. The debits and credits equal. And this is when we're all done. The debits and credits equal. Debits and credits will always be equal. I talked about this a little bit last week. You can prepare the financial statements directly from the trial balance, because these are your assets and your liabilities, and this is your balance sheet, which is what you see going here and here. And then you have your, oops, sorry, that's a liability also. And then you have your equity, which is what you see going to here. And then last but not least,
you have your revenue and expenses, which goes to your income statement, which is what you see going here. So once you have your trial balance done, you are virtually done with your financial statements. All right, we're going to change the subject and we're going to talk about a special type of account. We're going to talk about closing entries. So there's two types of accounts. There's permanent accounts and there's temporary accounts. Permanent accounts carry their balance from period to period. Temporary accounts don't. Temporary accounts we're going to reduce to zero and put those amounts over into the retained earnings account. It's easy to remember which are permanent and which are temporary accounts. Permanent accounts are like all of the balance sheet accounts, the assets, the capital, the liabilities, because you wouldn't say at the beginning of the year, oh shoot, it's January 1st. That means we have to reduce cash to zero, get rid of all of our cash. Of course you wouldn't do that. Unfortunately, you wouldn't do it with liabilities either. Oh, look, it's the first of the month, the first of the year, we can cancel out all of our payables. No, that's not going to happen either. The temporary accounts are revenue, withdrawals, expenses, and income summary. You're only going to see income summary during the closing process. It's so temporary, it's not even really a real account. Here's what we're doing with closing entries. There's 4 steps. When I say close, what close means is reduce it to zero. So we're going to change all of the revenue accounts to zero and put them in income summary. We're going to change all of the expense accounts to zero and put them in income summary. We're going to change the income summary balance to zero and put it in retained earnings. We're going to make dividends zero and put that in retained earnings. What we're really doing with these entries is we're making the books the same as what we did with our statement of retained earnings. So here we have revenue and expenses. These together give us our net income. That's really what this is. This is our net income. If you look at our statement of retained earnings, that's what we did right here. We added net income to retained earnings. And then the second part are dividends. When we make dividends zero and put them into retained earnings, that's what we're doing here. We're reducing retained earnings by the amount of dividends. So when we're done with this closing process, this balance in retained earnings is what we'll see on our books. So from a high level, that's the steps of the closing process, and it's why we do it. So it's easiest to see it if you look at a trial balance. So looking at a trial balance, the first thing we're going to do is we're going to close revenue to income summary. So we're going to so first we have to figure out where does that start. So cash, laundry supplies, prepaid insurance, laundry equipment, accumulated depreciation, these are all assets. Assets are permanent. Wages payable, that's a liability. Accounts payable, liabilities are permanent. Common stock is permanent, retained earnings are permanent. So all of these are permanent. We're not worried about them. So let's start with revenue. This is our revenue account. And it has a credit balance of $232,200. So how do we make this zero? If we have a credit balance of 232, if we're looking at it like this, and we have a credit balance of $232,200 and we want to make it zero, we need to debit it $232,200 is how we make it zero. So to close this account, we're going to debit laundry revenue. I'm going to abbreviate because I don't have a lot of room. And we're going to put that into income summary for $232,200. Now, once we've done this, our balance in laundry revenue is 0 because everything's in the income summary account. There is an alternative way of doing it. If you don't use income summary, you can close it directly to retained earnings. And that would look like we're still going to debit our laundry revenue, but instead of putting it in income summary, we put it directly into retained earnings. You can do that also. All right, now revenue 0. The next thing we're going to do is we're going to close expenses. So we need to identify them. So we have a bunch of expenses. So I'm not going to write out the whole entry, but I am going to start it. So the way we're going to do this is all of our expenses are debits. So if my wage expense is $126,300, how do I make it 0? I have to credit it $126,300. And that's going to be true for every single one of these expenses. So we're going to close expenses to income summary. So we're going to have one income summary account, and all of the rest are going to be credits to make the expenses 0. So you're going to have a lot of accounts here. We'll have wages expense, rent expense, laundry supplies expense, depreciation expense. You're going to go down and list every single one of the expenses. And then like wages expense is going to be a credit of $126,300. And rent expense is going to be a credit of $40,000. And I'm going to keep listing on down there. My income summary account is going to be the total of all of those. I'm going to add all of my credits up, and I'm going to put that as a debit in income summary. Just like the previous example with revenue, instead of using income summary, we could put it or take it directly out of retained earnings. You can do either one. The reason that we like the income summary account is because in that income summary account, we have debit and credit, right? When we close revenue, we debit revenue and credit income summary. So our revenue goes into our income summary account as a credit, and our expenses, we debit our income summary account. So if you're manually closing the books, this account is a check figure for our net income. That's why we use the income summary account. Now, when we close the income summary account, all we're going to do is typically, just like I said before, because revenue, and this side is an expense, hopefully we end up with net income, right? That would be the preferable thing. So when we close income summary, we're taking our retained earnings account and we're going to take this balance and we want to make it go away. We want to make it 0. So we're going to have to debit our income summary account and credit retained earnings for that net income amount. That's why we like the income summary account. When we're all done, the last step is we're going to close dividends to income summary. So we're going to go in here. We're going to go back up here. We're going to look at our dividends account. Dividends has a $5,000 debit balance. So how do we make that zero? We're going to have to credit dividends $5,000. So I'm going to debit income summary and credit dividends for $5,000. When I'm done with this, in my retained earnings account, I have put net income and I have subtracted dividends. So when I'm done on my adjusted trial balance, I will not see any of my temporary accounts. All of these accounts will not be on here because their balance would be zero after I did those adjusting entries, closing entries. And this retained earnings balance would be the same as on my financial statements. Because it will include, it'll be increased for income and it'll be decreased for dividends. And that's our adjusted trial balance. Last topic. You should know we're going to take the basics of the balance sheet that we've already done, and we're going to break it into current assets. Current assets are going to be used up in a year, the next 12 months. So these are current assets. Cash, short-term investments, accounts receivable, inventory, prepaid expenses. Then we have long-term investments. These are things that are going to be used up after the next 12 months. And then we have plant assets. Plant assets are all of those assets that we would depreciate, like furniture, fixtures, equipment, buildings, land, and intangible assets, which also have infinite lives or long lives, one or the other. Things like trademarks, patents, goodwill, which you'll learn about. All of those are intangible assets. So we've simply taken the balance sheet and broken it into more categories. The same thing goes with liabilities. We have our current liabilities and our long-term liabilities. Current liabilities are liabilities that we expect to pay off within the next 12 months, like accounts payable, wages, long-term liabilities to pay off after the next 12 months. Usually 30 years long, right? We're going to put the current portion of our long-term liabilities, like the portion that we plan to pay over the next 12 months, we're going to put under our current liabilities. And then all the rest goes under long-term liabilities. And we are done. Let me stop sharing. Okay, so you have your IP this week. You have your discussion board post. Please, please, please do it. The discussion board post focuses on what an accrual entry is, which is what we spent the whole class talking about. And you have to identify a particular accrual entry and explain the entry and why it's an adjusting entry. So you should be able to do that after going through IntelliPath and listening to this live chat. So as always, please reach out to your instructor if you have questions. Please go to their help sessions, their workshops, and I look forward to seeing you in week 3.